If you want to go from being a one-man, two-man shop, closing a deal here and there with great margins, that's one thing. But if you want to build an institutional operation like how we operate today, you're going to have to go and really invest in, like you said, hiring key people.
Welcome to the Fully Funded Show. Whether you're a capital raiser, deal sponsor, fund manager, or LP investor, we've got the insights you need for investing success. Join Sam Silverman each week for expert interviews, insider tips, and strategies to fully fund your ventures. Let's go!
All right, we are back with the Fully Funded Show. This time we actually have our first ever repeat guest, Rob Beardsley. Rob, thanks for coming on.
Yeah, excited to do it.
So today I want to talk about a topic that I think is not covered enough at all, right? When people look at these larger operations, whether they are real estate, private equity, they see the big numbers when looking at asset under management, right? When you see anyone's headline on social media, you see we have this much AUM. But what I think a lot of people don't understand, especially if who aren't in the industry, is how does that translate to earnings to the sponsor? Where does it come from? What do startup costs look like? So to the listeners some background, right? How did you start your firm? And kind of what costs go into starting and building out a firm that's more than, say, a one-man shop?
Yeah. So I think this would be a really interesting topic. For me, I started Lone Star Capital with my business partner, Ken, and this was back in early 2018. So for us, it was kind of the dream that a lot of sponsors start with, which is the idea of, well, if I can buy a $10 million property, I can charge a 2% acquisition fee. That's $200,000. I just made $200K off of one deal, right? And so a lot of people just chase, and I'm not saying this is wrong, right? I mean, that's the numbers and it's a great business, but a lot of people chase that initial idea and think, oh, this is a cheat code. This is my way to make a ton of money. And we like a lot of people, that's kind of what we started with the idea in mind. That was our underwriting at a business level, right? And so you do your first couple deals and you get the big pop of the acquisition fee. And because you have so few assets under management, the asset management fee is negligible. You're talking, you buy a $10 million deal. That $10 million deal probably produces around $1 million of revenue. You typically charge a 2% asset management fee on revenue. So you're talking $20K per year in asset management fees, right, off of that deal. So that's not keeping even the lights on, right? So you're living off of your acquisition fees. But the beautiful thing is like you said, you're a one-man, two-man shop. And so you don't really have much to keep the lights on. So when you get that acquisition fee pop as a first time or very early on sponsor, it's almost all profit. So it's super exciting, right? You close a deal, 200K fee, 400K fee. Wow. This is a big pop to your personal income as a starting sponsor.
So that initial fee, especially being a two-man shop, right? It was you and it was Kent. So that sustains you to go live for a period of time and keep looking for deals. But when you look at growing and scaling, I think people at times look at deals and say, this is a $40 million deal or a $50 million deal. There's $1 million acquisition fee that comes in there. Walk us through the type of hires that you start to go make as you scale, right? You start just you and Kent, and as you look to go scale and grow and become more of an actual company versus two guys doing great deals, what does that look like in terms of who you hire, what that costs you as a team, and kind of how that starts breaking up as you get taken fees and how that affects your bottom line overall?
Yeah. The bottom line is the critical thing, right? This as well as anyone in business, it's not about the revenue, it's about the profit, right? And so as you go through this evolution, you, as a sponsor, you kind of get this, in a way, wake up call where you're used to having all your revenue be almost all profit to seeing, and I don't know if this has to be the case with everyone, but I imagine that it's pretty common where basically your profit margin goes from 80% to like 20% because you kind of go through this growing pain phase where you really need to invest in the business in order to grow it further. If you want to go from being a one-man, two-man shop, closing a deal here and there with great margins, that's one thing. But if you want to build an institutional operation like how we operate today, you're going to have to go and really invest in, like you said, hiring key people, which is going to cut into your margins. You might have to get a big fancy office like this, which is going to cut into your margins, and so on and so forth. So for us, I think the first hire that most people make, and us included, was someone to head acquisitions, because acquisitions, when you're starting out, is the most time consuming and repeatable part of the business. You don't yet have a big portfolio, so it's not like you need a robust asset management team to asset manage, right? Which comes later, and we'll talk about that. So really the most time consuming part of the business is the acquisition side. And like I said, it's repeatable, which means you can train someone to do something and then they can do it over and over and over again. So it can free up and leverage the founder's time to continue to grow the business. So that might, quality acquisitions person, obviously if you're small and scrappy, you might be able to get someone for a very low salary and give them equity and bonuses and whatnot. But, market rate, if you're just kind of looking at surveys for real estate acquisitions people, for like an associate director level, you're talking about cash compensation between salary and cash bonus of somewhere between $150,000 to $250,000, which there's your $200K acquisition fee gone, right? That you have to do another deal just to kind of break even on that higher decision.
Yeah, I think that's something people struggle with, and I've seen as well in my own business too, is the bigger you grow, your margins take a huge step back, we really take a few steps forward, and also allow you to go focus on different things in your business, right? When you were first starting out, you're probably doing everything from off-market deals to underwriting to calling brokers to going out to see properties and managing those properties, right? You were doing a ton of different types of roles. So as you get bigger, you can start hiring people to go take those roles off your plate. And when you look at bringing on a person, how do you measure if they're successful in terms of dollar in versus dollar out? Like, is there a certain multiple that you try and get on each hire when looking at their profitability versus their costs?
I think there's a lot of smart ways to think about these decisions. For example, we were just talking about the book Buy Back Your Time by Dan Martell, which I just kind of skimmed/read over the weekend. And his philosophy is you take your hourly rate as the entrepreneur or the CEO or the founder. And the heuristic for that is just take your distributions or the profit that you take from the business, divide that by 2,000. That's approximately your cost per or your value per hour. And then he divides it by 4. And if you can hire someone to outsource a task that you're currently doing at effectively the quarter of your cost per hour, then it's a worthwhile endeavor. I think that's a really smart way to think about it. I think there's also more brass tacks ways, and we didn't really look at things from a mathematical perspective. We did things more so out of a necessity perspective, where you just get to a point where there's just too much work, and in order to handle the job, you just physically have to hire it. And I think that's a really good way. As I've gained more business experience, I've learned that there's the option to hire before the need. You kind of basically hire people in anticipation of the growth. And you would do that if you have the capital to kind of pre-fund the growth, if you will. Or you would do that if you're very confident in the growth of the business. Conversely, you can hire at the need or kind of beyond the need. Like once things start breaking, then you can hire. And I feel like that's actually the better way to go, because there's a lot of slack in business. And right, you've worked for big companies, you work for small companies, and I'm sure you've seen how, especially in big companies, there ends up being a lot of fat where a person, they might be busy sometimes, but then they kind of slip through the cracks, then they're not busy at all. And that's what we want to avoid. We want to maintain the leanness that we started with as we grow into a bigger and bigger company. So for us, it's following the path of growth, going from acquisitions, then the portfolio is growing, then you need to hire asset management, and then the portfolio continues to grow, you need to hire more asset management, and then layers, and we can kind of dive into those specifics. But yeah, I would say it's been kind of when things start to break, that's when we look to hire rather than have some sort of like strategic calculation or breakdown.
Yeah, and I've seen both sides of this. I've worked for, like you said, super small startups. I started companies where I'm the only employee myself as well. And I've also worked for 3,000 person companies too. And you have a lot more slack and a lot more layers in those companies. So on your end now, how do you think about layering folks? Like, do you guys start as this person coming on can be the senior person? They have a lot of experience in this area. They can hire someone under them. Or do you think about it in the sense where we're going to bring on someone who could grow into that role and ideally groom them to be that person, eventually give them more opportunity if they perform well to go have layers of people under them based on business growth?
Yeah, we really like hiring people towards more of the entry level and then having them grow with the firm. There's a few reasons for that. One is they're usually more coachable than someone who has more tenure because they have the baggage of their previous employment, which can be good or bad, right? Sometimes you need a specialist who has that prior experience to be able to come and solve technical and specific problems for your business. But frankly, oftentimes, if you bring someone who is young and energetic and coachable, those are the only traits that you need for them to go and be successful if you provide them the right resources. So it's a balance of, are you willing to backfill a less experienced person with the more hands-on coaching and oversight? Or are you looking to bring someone in who can be more autonomous and is going to kind of lead you rather than you leading them? So I think for most positions, you can get away with the former and actually be very successful. And what you'll do is you will hire somebody for less because they're coming in at a lower position and coming in with lesser experience. They're going to be, like I said, more coachable. The opportunity to grow with you is going to engender more loyalty, and that's incredibly valuable to us as a business. Turnover is very pernicious to a business and, to growth and to cost. So if we can keep our turnover rate low, tenure up, those are things that are really important to us. So that's been our strategy, and that's been pretty successful. And that strategy extends beyond just our corporate team. It's also permeating to the on-site staff. So we are vertically integrated. So we own and operate a portfolio of multifamily properties that's about 700 million worth. So we have about 22 properties that we manage, and each property has a staff of around 4 to 8 people. So each of those properties is a small little business in itself. And you can make these same exact business decisions at that micro business level. You can decide, do I want to hire a manager with 20 years experience? And then they're going to bring their whole team with them and hire up and run the show the way they know? Or do we want to hire someone at the leasing agent position and then over time groom them, grow them to become an assistant community manager? Then they become a community manager. And frankly, that's what we're building towards. And it's easier to say, harder to do, because you need more corporate infrastructure in order to be able to effectuate that. It's actually it's funny to say, but it's kind of the lazy approach to just say, well, I'm going to hire a super experienced manager and then I'm going to place them at this property and they're going to be successful. When it works, it's incredible. It's like they're just making magic happen for you. But when it doesn't work, it's incredibly costly. And again, it goes back to turnover, because then you've got to restart the recruiting process, hire again. And again, there's no guarantee that you get it right. So there's a more higher chance of getting it right when you hire someone at the lower level and then groom them up and then place them into a position of authority where they can be successful. But you have to, like I said, be able to have the time and infrastructure to actually train them, which I don't want to get too carried away, but we're actually launching an initiative which actually we just started called Lone Star University. And it's going to be with a lot of coaching and certifications and everything. It's going to be a way for us to teach every function in our business and empower everyone in the company to learn more and to rise up through the company.
Yeah, a company that does this really well too on a corporate level is Chick-fil-A. So if you look at what they do, anyone in their senior leadership team has started from, and it could be off base, but I think like directionally right, they've started from taking orders. They've started from working a drive-through window. They started from working store in some capacity. So each of their franchise owners, right, they're people who have been through the ranks of the company, and the loyalty there is incredible, right? The experience. When you think of a quick service restaurant and you think of quality, right, you think of Chick-fil-A in that sense too, likely because that same intention. People have taken these roles and then step up each time and grown with the company, and that loyalty they have and culture fit can be so much better than someone who is a been there, done that type person that's headhunted and may or may not come up with an ego at times as well to a business. It's funny you mentioned this too. I know this weekend we were talking about it. We did, a few of us were together going through the culture index, which I know you all use extensively. Like, walk us through how you use that in hiring as well to make sure you're getting people who fit a certain type of role that you want and have a certain personality that you feel so you can go mold to be someone who fits there long term.
Yeah. Culture Index is something super exciting that we rolled out this year. And as you saw, we were hanging out with friends in my living room, and we just had a few of our friends take the Culture Index survey, which is cool because it only takes about 8 minutes. So it's not a huge burden to where you can even get a friend to do it quickly. or you can get a applicant for a new position to take as well. So we don't even consider an applicant unless they've taken that culture index. And it does a couple things. Obviously, it shows a slightly higher level of buy-in, right? If they're willing to take that, doesn't mean that they are super bought in, but if they're not, then we can immediately ignore them and say, okay, well, they didn't even follow instructions and they didn't do the bare minimum, so we're not even going to review their application. But the culture index is a very simple way to get a lot of insight into someone's personality. And like I mentioned before, talk about energetic, coachable, I forget the other word I used, but these traits are, maybe you can kind of figure certain of those elements out on an interview. But an interview is very difficult because an interview is a performance for 30 minutes, right? And so anyone can be anyone for 30 minutes. And so it's kind of red pilling or black pilling, depending on, what the kids are saying these days, to go through an interview process, be really excited about someone, hire them, and then see it all fall apart. And so at this point, we've seen it all. And we've seen that happen multiple times to the point where everyone on the team has been burned in a certain way. Right? Everyone on the asset management team, everyone on the property management team, they've hired a leasing agent, they've hired a community manager, they've hired so-and-so who they were so excited about. They were coming to us and bragging and saying, we just hired this person, they're going to crush it. And then it all falls apart. And so it's shown all of us that an interview is an imperfect science. And traditionally, you have the interview and you have the resume, and then you try to put those together and make sense of it. Well, culture index is the third leg of that stool, which really puts everything together and kind of supercharges it all. So the culture index survey gives us insight into who the person is personality-wise, as far as perhaps their teamwork, their leadership, their social ability, and desire to be social or not social. And that kind of gives us insight into how they work, into how they learn, into how they want to work, their pace, their organization. So these are key traits for business. And there's not one personality that we're looking for. We're looking for the right personality for the position. So it gives us a lot of clarity to understand, okay, this is the type of profile culture index that we want for this role. And then we just start to see all the applications come in and we look for the right match. And then when we get on the interview, we're looking for ways to prove or disprove our hypothesis generated from culture index, right? Because culture index, obviously, it's a 8-minute test. It's not going to be perfect. But as you saw over the weekend with all of our friends, nobody disagreed with anything I had to say about just reading a couple quick dots, right? Everyone was like, oh yeah, that's spot on. That's true. So yeah, it's just a really cool way to get a leg up on hiring, because the statistics show that hiring is only about 25% successful. And just think about how expensive that 75% of the time mistake is.
Yeah, I mean, we experienced it too. So my background prior to this was running large sales teams. I think I hired probably 400 total sales reps over a course of a handful of years, and you see it all. Like, if you were really good, because you're hiring, at least in our world, you're hiring people who were entry level, career changers, maybe one job and switching the same industry. Like, if you got 2/3 right, you were nailing it. And you had a lot of turnover, you had a lot of training, a lot of ramp up, a lot of infrastructure you needed to go support these people who were either coming in, and if they did well, they promoted out of the role. If they didn't do well, they were fired. If they did okay, they kind of hung around. So you had those 2 buckets of people, and you had to go build infrastructure to support each one of those folks as well. So I want to shift gears here a bit. I think a lot of people, they see, again, the big AUM numbers, they see certain areas, they want to understand, where does money come from when looking at how a sponsor can make earnings, when looking at kind of that side of the world, right? You always hear we align with our investors, right? We put them first in terms of how things are structured. So walk us through a typical deal that you're buying and kind of where you project profits to come from as well.
Yeah. So we started talking about the evolution, starting with your first deal and hunting and taking down the first deal. The first one's always the hardest. It's very exciting. You get the big acquisition fee up front. The asset management fee is negligible because it's a small deal and you've got a portfolio of 1 or 2 deals. So, and you're not vertically integrated, and it takes a long time for really the ongoing fees associated with property management fees and asset management fees to really make a meaningful impact to your revenue. But if we fast forward to today and we're looking at ideally buying deals that are about 50 million in size. And like you said, if we're charging a 2% acquisition fee on that, that's $1 million acquisition fee. So those are still the big pops, but now because the portfolio is about 700 million in assets, now the recurring fees are substantial as well. So they're competing depending on how much acquisition volume we do in a year. It's kind of competition for revenue. So, ideally you're in a case where your portfolio has grown up to the point where you're making about the same amount in annual revenue as your acquisition fee volume, which is helpful because you obviously want to grow, but you want to not necessarily be scrambling for the next acquisition fee, because that's a stressful way to be, and it's not a strong foundation to be able to operate from. The best deal that you could ever do is walking away from the wrong deal, right? And that is harder to do when you're relying upon the next fee to bridge you to the next quarter. So today, like we talked about the erosion of margin as we're in a growth phase, this year has been a huge investment into operations. We've hired a lot of people in the property management side of business. We've hired 2 more asset managers. We hired community operations manager, a couple regional managers. We hired up on kind of the back office stuff in terms of invoice processor, accountants, controller, COO. So it's been a lot of hiring, which again hurts the margin, but it's exciting because it's building the right foundation to take us to the next level of scale. So long story short, when that $1 million acquisition fee comes in, today we're only targeting, I would say, max 40% of that to be actually taken out as profit. Because right now we're very focused on building up the foundation. And so, we kind of allocate and set aside a lot of that fee right back into the business in operating expenses.
Yeah. And when you look at those operating expenses, like what consists of that, right? Is that team members? Is that partners? Like where does that remaining $600,000 go in a deal like that?
Yeah, it's really payroll. Payroll is the biggest expense in a business like ours. We're a service business. We have a lot of highly paid professionals, investment professionals. We have investor relations people. We have marketing people. We have asset management. We've got the property management. So there's a lot of infrastructure to just handle the day-to-day operation of having 100 employees, having hundreds of thousands of dollars of expenses every month. You've got invoices, you've got credit cards, you've got accounting. So there's just your operation becomes very big. And so you need to have a lot of people to support that. Payroll, you look at, this is actually really interesting. The decision to lease an office here at the One World Trade Center, I want to say it was done back in, 2021. And I think we probably moved in 22. It took a long time for the space to be prepared, for us to finally move in. And then it took a long time for the furniture to come in. So it's been a long process. But the decision happened way back when. And back then, this was a really big deal, right? The office lease is about $30,000 a month. And that's still a big number today. But back then, you can imagine it was even bigger for us, right? Our portfolio was less than half the size. So it was a big decision for Kent and myself to take the plunge and want to do something like this. And, to some people, it might be like, oh, you guys are being frivolous with your revenue by just wasting it on an expensive office. You could have gotten a perfectly good office for half the price. And you're right. But the decision was a bet on ourselves that we would be able to establish a stronger brand. We would be able to leverage the office to attract more investors, to attract more employees that would want to show up to work every day here, and so on and so forth. So we saw the intangibles as well as the tangibles associated with making an investment like this. So point being is back then, that $30K a month was a big portion of our revenue, and it was a big hit. It was a big decision. But you fast forward to today, and it's like, okay, well, our payroll dwarfs the office expense. So you look at the admin costs, we've got a lot of costs. You look at the numbers, the gross numbers, and it's like, oh, wow, we're spending that much on paying for everyone's travel from here to Texas and, to go to conferences. Oh, like for Craig to go to a conference to meet some family offices. Oh, it's $10,000 trip for the ticket, for the flights, for the hotels. The hotels that these conferences are at, they're not cheap. So we've got travel, meals and entertainment and the office, that's kind of your admin stuff. And that is, you know, it's like $600,000. So, if you're making consistent acquisition fees of $1 million every quarter or so, you're going to be able to cover your admin, but the payroll is where it really is going to add up.
Yeah. And so let's take a sample deal, for example, as well, right? I think a lot of people see these big fees that you make. How does that fee compare relatively to the total promote structure that the corporate team will make if that deal hits its pro forma as a percentage?
Yeah, this is another great topic. So it's fun to be able to talk about this stuff because, like you said at the beginning of the show, a lot of people haven't talked about this. Perhaps they aren't willing to share. I'm not really sure. But I think it's really healthy to dig into this stuff, whether you are an investor, maybe specifically a fund manager, or if you're in the seat of, like myself, in the sponsor role, because we're not doing this just for fun, and we're not doing this just because we want to grow the biggest portfolio, right? We want to be profitable here, right? And so we need to think about and be judicious about where our profits are coming and so on. So yeah, to your point, the business isn't only driven on fees. It is at first, because to get to a promote takes a while. If you're very lucky, you might time the market really well. You might have a quick flip on a value add deal where in 2 years or 3 years, you could sell the property, and because you're the sponsor, you get a profit participation upon sale. You can get some really meaningful pops that equal or are even greater than the upfront acquisition fee that you got a few years before when you bought the deal. So to break it down, let's take an example, $100 million acquisition. And you can think about it as one big $100 million deal. You could think about it as 10 $10 million deals.
Sure.
Just basically, if you're acquiring $100 million, let's go through the paces, right? You've got a 2% acquisition fee, so that'd be a $2 million there of revenue. You're going to have a 2% asset management fee. And then for the purposes of this conversation, we can also assume you're vertically integrated, right? So you built out the capabilities to manage in-house, which is generally speaking the direction that all sponsors go in. That's just kind of how it goes. Usually someone gets to 1,000 units, maybe 5,000 units, and then they bring operations in-house. So if you're making 5% in total on revenue, 3% from the property management fee, 2% from the asset management fee, and let's say your portfolio size is 100 million, just to use the simple numbers, and I use about a 10x multiple on revenue. So you'd say 10 million of revenue, take 5% of that, it's $500,000. So so now you got 2 million up front, 500K annually, and then the promote is where you have the most variability. Obviously, because it's not a fee, so it's not a defined contractual earning there. It's a profit split. So depending on how well the deal performs is going to impact the sponsor's fees. And so when we talk about leverage in real estate, meaning taking on debt, we all know that the more debt you take on in a deal, the more it exacerbates the outcome in either direction, right? The more debt you take on, the more you make, or the more you can lose, right? So same with the promote. The promote is even more levered than the investor's projected return, right? So you might be incentivized to leverage up the deal so that your investors are projected to make more. But also, if you lever up the deal, your promote can be projected to make more, because the promote is the very last thing to get paid out. It's the very last marginal return, right? So when you squeeze out an extra $1 million on the sale price, if you have a 70-30 split with your investors, that's an extra $300K that you make as a sponsor. And if you're selling a $50 million deal, right, $1 million is only 2% of the property value. So if you can squeeze an extra 2% of property value, you can make an extra $300K as a sponsor. So those numbers can really add up. And if we use our $100 million portfolio example, then it's an extra $600K. So my heuristic is on a typical retail LP promote split. Just to give you an example, our promote structure for a Class A investor with a 50K minimum is an 8% pref, cumulative and compounded, subject to return of capital. Then we go 70-30, 70% to the investor, 30% to the sponsor, up to a 15% IRR. After investors have received a compounding 15% return on their money, then we split the remaining profits 50-50. So if the deal goes to plan and does well, because again, don't listen to what anybody says, underwriting is always aggressive. It's never conservative.
And in most of your deals, you model to about that 15 or so, right?
Yeah. Most deals we underwrite to around a 15% return. So the 50-50 split isn't really coming into play that much in our projected numbers. And that's why I wouldn't go so far as to call it a home run hurdle. Some people call kind of that back end hurdle the home run hurdle, where if the deal's a home run, you're making an amazing split as a sponsor. But it kind of is a home run hurdle. Like if the deal just totally performs and outperforms, then we're going to get the benefit as well as our investors. So if you perform to plan, which again is most likely an aggressive plan because underwriting has to be aggressive by nature to be able to compete and pay the most for the deal and win the bid and then entice investors to invest. That's just the nature of the business, unfortunately. With that being said, we try our best to underpromise and overdeliver. So we're trying to thread that needle, which is a very, very tight window of how do we underwrite aggressively so the returns look attractive, but then how do we still underpromise and overdeliver for our investors? That's a whole nother podcast. But with that being said, assuming the deal goes to plan, the sponsor can expect somewhere around 10% of the property value in promote if they go to plan and they get a 70-30 over 8, 50-50 over 15. Also, leverage plays a big role, which I can explain in a moment because it is counterintuitive. But I just want to explain the heuristic. So if you buy $100 million, you crush it on those business plans. 5 years later, you sell all those deals that you bought for $100 million. The sponsor would be projected to make $10 million. Now, again, keep it in mind. That's 5 years later. Sure. That's if you hit everything on your projections. And that's if you raised all the money at those Class A terms. Now, the vast majority of sponsors, they'll tell you they're not raising all their money, perhaps not even most of their money, at those most favorable terms.
Because on the 100 million, you need to go out and raise 35 super low end, more likely 40, 45, 50.
Right. And in order to do that, you're most likely bringing in a substantial portion of that through fund managers. And fund managers are going to negotiate a different promote split, right? It might be a 80-20 over an 8 or a 9, or it might be even worse, right? And so you're talking about very easily, very quickly cutting your projected promote as a sponsor in half, going from 10 million on the 100 million 5 years down the road to 5 million. So, and when I look at it, I want to be conservative. And so I look at discounting it for the uncertainty of performance, the time value of money, right? We're talking about making this money 5 years down the road, as well as the likelihood that I have to do side deals with, bigger investors. Like we have investors all the time, family offices, for example, that say, hey, I'll invest $5 million, but, we're going to need a side agreement to enhance the waterfall in their favor. And we say, yes, of course, because they're bringing us $5 million, not $50K, right? It's the classic buy in bulk principle, right? They're going to get a bulk discount. So with all that being said, I back it down all the way from 10 million on 100 million to assuming 4 million in promote on 100 million. That's kind of my assumption. And I think that's how sponsors should think about it if they've got their business set up relatively similarly to ours.
So let's walk those numbers again. So $100 million either purchase or hold purchase to get that amount, $2 million upfront in terms of acquisition fees. If you're vertically integrated in the real estate space, you're looking at probably a 2% spread in the property management business, right, per year. And then you're looking at, 3% spread for management business per year, and 2% in terms of asset management fees. So in total, $2 million upfront, $500,000 per year over, call it a 5-year window based on pro forma. So you're looking at about $4.5 million of profit throughout the whole period in terms of highly likely fees or guaranteed compensation. The exit, you're looking between 4 million and potentially as high as 10 million. Here's the thing as well to think about is that if you can go overperform those numbers in a big way, that 4 million can quickly become 10, 12, 15 if things go very well, or if you get some level of tailwinds, or if you exit earlier, right? Because that's where you get into your promote structure much more quickly. You make a really good point too, is that if you have capital partners or if you have side deals, that margin in the back end gets smaller and smaller and smaller. And we've seen some sponsors go as high as 90-10 in terms of splits. Like, how do you think about your fee structures versus the market when looking at how you price things in terms of high likely or guaranteed type fees versus upside in transactions to really align with your sponsors?
And before we dive into that, I also just want to take the flip side, right? You mentioned there's the opportunity to outperform, which 100%, no deal is going to go exactly to pro forma. It's going to either be slightly above, slightly below, or a lot above, or a lot below, right? So you might have deals, every projection's wrong. Every projection is wrong. And so you might end up with a deal that you were hoping to sell and make $1 million promote on, and you might make zero. Because again, the investors get their minimum return first before any sponsor promote. So you might be, again, that $100 million might be a collection of a handful of deals, and one of the deals might underperform. You might make $0 on the promote, and then another deal, you might double what you expected to make on the promote. And like you also said, you might sell in 2 years instead of 5 years. So you're going to get to that promote sooner, and the IRR is going to be great for investors, but the promote's not going to be that great from a dollar perspective because the deal just didn't have as much time. Just generally speaking, obviously, if you can get the great exit and shorter time, right? You get the number you want and in less time, then you can have it all. But generally speaking, the actual dollars are going to be less because the equity multiple is less. It might be an amazing IRR. It's like a 40 IRR, 50 IRR, but the equity multiple is 1.4, 1.5. It's just a short amount of time. So there's a lot of play there. And then also the interesting thing is when we talk about fees, we consider fees as essentially guaranteed revenue for the sponsor, right? But that also cannot be true. For example, we have a couple deals that are underperforming because of floating rate debt that we purchased in 2021, and we haven't been collecting an asset management fee on those deals for a couple of years. So that's revenue that we've just foregone. And because we have the luxury of being vertically integrated, we can also even forego the property management fee as well in those deals to really try to help our investors as much as we can on those deals. If you're not vertically integrated, then you're working with a third-party management company and you can't just stop paying your third-party management company. So that's another benefit for investors. Obviously, you don't want to go into any deal with the game plan of, oh, this deal is going to underperform and we're going to be able to not charge our investors fees. That's not the plan, obviously, but it is important. It's an important tool to have in your toolkit because we want to have a 40-year relationship with those investors in the one or two deals that happens to be going poorly, right? And we want them to reinvest with us. And I think that's a real sign of successful investor relations and handling our business maturely is that we can have deals that are underperforming, that are not making distributions, but we can do the right thing. We can over-communicate. We can actually defer or even write off property management fees, asset management fees, and then those investors will end up continuing to be repeat investors. So anyway, that's kind of the downside as far as, fees and promote. Right. So the industry has matured a lot over the last few years and has become much more sophisticated. And specifically, I'm talking about the co-GP model versus the fund-to-fund model. So just to tell a little history, the predominant way that people were raising capital for sponsors, and so for people who maybe aren't familiar with the capital raising business is, if you have been listening to this podcast and you're hearing about all the hiring and the culture index and the firing in the office and all this, and it's very overwhelming and vertically integrated and property management, all this stuff, it's true. It's a lot to do. And so a lot of people opt to leverage their skills and their network to fundraise and raise capital from investors and then partner with a sponsor like us who does have all the infrastructure and then place that capital with us. And then they get compensation for playing that role of investor relations and fundraising. And so that was predominantly done through a co-GP model where they would come in and effectively become a part GP partner on a particular deal. So exactly what we just went through, the asset management fees, the acquisition fees, the promote, those were all up to be shared with a co-GP partner coming in to raise capital. However, the SEC at times has taken issue, or there's just gray areas with the co-GP model because depending on how the deal is structured, it can be interpreted as acting as a broker dealer. So I don't want to get into all the SEC stuff, but a lot of people have pivoted from the co-GP model to the fund manager model, which is an more SEC compliant way to raise capital, where people are structuring their own funds and then syndicating capital into that fund and then investing into the main deal. So now it's essentially a fund-to-fund model where the fund is investing in another fund and the deal is subject to a double waterfall. And this is where you talked about sponsors will have a different set of fees perhaps and a different waterfall for the fund managers who are bringing capital in bulk. So if a fund manager is bringing us $2, $3, $4 million, that's really exciting to us. And so we'll, instead of charging a 70-30, we'll do an 80-20. And those numbers I'm throwing around may not sound like a lot, but that's a big difference if you're talking about the sponsor only earning 20% of the profits upon sale rather than 30% of the profits. Like I said, in sum, when you total all this up, it can be basically akin to the sponsor giving up half of their promote away, going from 10 million on the 100 million to 5 million. So the way I think about this is a couple ways. So the reason why I say it's become so much more sophisticated is because before people would say, yeah, I'd like to be a co-GP on this deal. Yeah, why don't you just give me like this piece of the deal and I'll raise money and let's go. So it wasn't really that mathematic. But with the fund manager structure, everyone's become very attuned to how much they're projected to make. And now that's what fund managers all want to talk about. They want to talk about, how much am I projected to earn on the dollars that I raise? If I'm going to raise you $1 million, what do I get out of it? And I think this is a fair thing. I think it's all about, business and life is all about what's in it for me. So I don't begrudge that. But people have become a bit hyper fixated on those numbers without actually looking through those numbers and figuring out, how are we getting to those numbers? And so to explain how we're getting to those numbers, basically the way that it works is you've got a project level return for the deal. And typically project level returns are going to be somewhere around, let's say 20% IRR. So before anyone takes a fee, before anything happens, it's a 20% return. Then of course the sponsor is going to typically take their fees, acquisition fee, asset management fee, and that's going to bring down that 20 to maybe like an 18% return. Then the sponsor is going to take their share of the profits upon sale. And that will go from 18 to, let's say, 15% return. So now they go to their investors and they say, hey, this is a great deal. We're projecting a 15% return. And then investors start investing, 50K, 50K, 100K. But a fund manager shows up and says, okay, I want to raise money for this deal too. So why don't you discount your promote structure to the 80-20 or the 90-10? And now the fund is projected to make not 15, but let's say 16.5, 17%. And then the fund manager takes a small fee and takes a small piece of the profits at the fund level and then distributes 15% to their investors. So it's a little bit confusing, but you can see that in the end, the investor either directly is projected to earn a 15% return, or the investor through the fund-to-fund vehicle is also projected to earn 15% return. So the way we think about it is we want to offer a fair deal where if a partner is coming and raising capital for us, we still want their investors to earn a return commensurate with what we're projecting for our direct investors. And we want our fund managers to project to make somewhere around 10 to 12% of the capital they raise, which means over a 5-year projected hold, we want them to make, let's say, 2% of what they raise up front. So if they raise $1 million, they're going to make 20K up front and then another 100K when we sell the property in 5 years. So then in total, they make $120,000 over 5 years, or 12% of the $1 million that they raise.
And when you look at it from like the fund manager point of view as well, what we see at times is that they're really focused on these end outcome type numbers, not really looking at the inputs always to get there. On your end, like, how do you feel as though you compete in the market with maybe other groups that are out there or other opportunities for them? Because right now in the world of capital raising, if you can go raise equity, right, you have a dedicated list of investors, you have a huge benefit, right? You're the pretty girl at the bar. You can go up to whoever you want and they'll likely hear you out. Because right now what we've seen is that there's more deals out there than there is capital. Capital's become harder to raise the last few years. So if you can go actually out and raise that capital, you have a lot of leverage to work with who you want, structure partnership, especially the more banked you have the equity, the more leverage you have. So what have you seen from fund managers in terms of how they approach scenarios, what they look for, how they go really dig into a deal and see, yes, the margin's protected here, but what's my likelihood of achieving that?
Yeah. So this is where I would like to see the next phase of sophistication of the business go to. Because like we said, it went from co-GPs saying, yeah, give me 5% of the GP and I'll raise $1 million, or, whatever it was. And it wasn't so mathematical and it wasn't so sophisticated. People weren't exactly calculating, if I raise $1 million, am I going to make 100 grand or 150 grand, right? Like counting it up like that. And then we've seen it become more and more sophisticated, and a fund structure has really brought that about. But like you said, people aren't really actually looking through those projections and underwriting and saying, okay, well, what's the exit cap? And let's sensitize the exit. And what's really interesting and what we're seeing as kind of a new thing, and I think this is perhaps the next level of underwriting that a fund manager should do, is what is the sponsor projected to make on the deal if the deal goes well? And what am I projected to make if the deal goes well? But what if the deal goes bad? What's the sponsor projected to make? And then what am I projected to make? Because again, we talk about the promote being the most levered part of the deal, right? A small tweak, 2% up and down of the sales price can materially impact the promote. Now, so what we've seen is with capital raisers wanting more and more, they want to make 10% on how much they raise. They want to make 12% on how much they raise. They want to make 14% how much on what they raise, right? So it's going up and up and up. So it's like a race to the top, which is actually a race to the bottom, because they're looking for that highest percentage and forsaking quality. Perhaps they're forsaking quality of sponsor, quality of underwriting, and the quality of the deal itself, right? Rather than looking at out for their investors as the number one most important element of the deal, they're looking out for themselves. And so this has created perverse incentives where sponsors could be willing to offer a more compelling projection to the fund manager just so that they can raise that capital. And the way to do it is it's pretty straightforward math. As a sponsor, I can increase my fees so that I get a guaranteed payment from the deal and then offer a more favorable share of the upside to the fund manager. And then I make my returns and my projections just generally more aggressive, but I don't have to bear the burden of the aggressive projections because my fund managers are the ones that are taking the bet on the upside, whereas the sponsor is making the fixed fee. So, I've just tried to keep Lone Star's fees within market. I've kind of learned that you don't really want to stick out in terms of your deal structure. You kind of just want to blend in. Sticking out gets investors prickly. It's like, oh, well, you're charging higher fees than other people. And even if you charge lower fees than everyone else, that also sticks out because investors are very cynical people. And if you're charging lower fees, they don't view that as an exciting discount. They view that as, what's wrong with you? There must be something wrong with the deal. There must be something inadequate about you as the sponsor. So I think if you just have down the middle fees and deal structure like what we do, I think that to me just makes me feel comfortable and that, hey, this is tried and true. This is thought out, and we are mutually roughly equally sharing in the upside of the deal. So you can see that, we're making our fees. It's absolutely keeping the lights on. We're growing our business. And then when the deal performs well, we get a part of the upside. The fund manager gets a part of the upside. And then, of course, most importantly, the investors, whether direct or indirect investors, are, of course, getting a fair return.
You guys, if you're a fund manager or capital partner, listen to this too, go do the extra homework. Go have someone from the team walk you through the underwriting. There's also all these places so you can have a deal underwritten for $100, $200 in a pretty simple way. It's not a huge cost at all. So understanding how the sponsors get paid, understanding how your investors get paid. I think a big thing here too is the fund manager model, making sure that as a fund manager, you can go off for returns that are equal, at least equal-ish to the sponsor themselves, because that creates that insulation for you versus saying, hey, we're going to go work through fund manager one versus going directly to the sponsor, right? Kind of add that layer of communication there as well. So to kind of close this out as well, I didn't recommend my time here too. When back to kind of the overall fee structure, operational piece of it, as an operator, right? And there's two routes people go. One route being we want to go build a large operation, right? So we're going to go invest, we're going to go hire, we're going to go really look to go bigger. And two, being the route that, hey, I'm okay doing a deal a year and to go live on a really great life, right? I can imagine those deals. What's that breaking point either way where you have to decide which route that you want to go based on what your vision is, the earnings tied to it? Because if you're not going to go big enough and you want to put in this infrastructure, you may not make enough money doing it. Or if you want to go the personal route and you go a little bit too big, things will break. It may not be a lifestyle that you personally want. So where do you think that breaking point is for trying to choose the direction that you want to go?
Yeah, it's a really great question. And also just going back to your point about fund managers taking the time to underwrite or utilizing someone to underwrite. If someone is looking at a deal, ours or just any multifamily deal where we could be of value and they're thinking about raising money, reach out to us and we'll crunch the numbers for you. We'll show you, okay, here's what the projected deal level return is, right? Those are the least manipulatable numbers. Like, you can only squeeze so much blood out of a stone, right? And so if the deal's a projected 20% return, like, there's only so much of that 20% return that can go around, right? And so some of that has to go to the sponsor, some of that has to go to the fund manager, and the biggest share of that has to go to the investor, right? Call it 15%, 16% projected to the investor. So we're really only dealing with that remaining 4% of projected return that can be divvied up between the sponsor and the fund manager. And as a fund manager, you want to know not just how much money you're projected to make on the capital you raise. You want to know quite literally, okay, if there's 4 points of IRR that can be going around, am I projected to make, one of those 4, 2 of those 4, and if the deal performs to an 18 instead of a 20, what does that mean for my return, right? Because if you get a more fair split of the returns, you want to see that on a sensitivity analysis, it's not like you go from, I'm projected to make 12% of my money, but if the deal doesn't perform, I make nothing, right? You want to have a good, nice range of outcomes where if the deal underperforms slightly, you're still making 8, something like that, maybe 6, right? So I'd love to get into with people and just kind of learn more about the deals that people are looking at and also help us get feedback on the deals that we're offering to make sure that we're in market and that we're able to provide the best solution. So back to your question, I think it really comes down to just building a budget. And this is a very personal thing too, because this is someone's business and no one can tell you how you want to run your business. I think I'm a pretty ambitious person, but I'm also comfortable with where I'm at and where I'm going. And there's kind of levels that I don't really care to go to. Like, I don't dream to frankly even have a $10 billion portfolio. I think it's in the cards. I think there's absolutely a way to do it and it may happen, but I don't dream of it. And I most certainly don't dream of 100 billion, right? So someone else could look at me and go, wow, you lack ambition. You have a closed mind, or, you have limiting beliefs. You could do better if you opened up your mind and did some affirmations and all this good stuff, right?
Journaling, yeah.
Yeah, right. So everyone's got their own levels and their own limiting beliefs and where they want to go. And I think you just need to pull out the budget and really look at it. Like, what kind of lifestyle do you want to live? What kind of work do you want to be doing and how much money do you want to be making? And then from there, you can actually start looking at it. Because like you said, if someone's doing this haphazardly and not really thinking through it, they might think, oh, I need to hire so-and-so because that's what I'm supposed to do. And then they hire the person, then they hire the next person. And before you know it, they're in a position like me where you have an enterprise and you need to do 100, 200, $300 million of deals in a year to feed the beast, right? Like, you got to keep growing. If you're not growing, you're dying. So that might not be what somebody wants. So you want to do it very thoughtfully and figure out, okay, I actually want to personally make $500K per year to live my life. And then you would say, okay, well, how much money do I need to pull in fees? Do I want it to come from acquisition fees and promote versus recurring fees? And, do I like doing a certain element of the business and I want to hang on to those things? Because, there's a lot of things that I don't do anymore. Like, I don't underwrite deals anymore. And that was my favorite thing to do. right? So I could look at that and go, oh gosh, that's a downside of growing bigger is I'm no longer doing some of the things I like doing. So I think it's a highly personal thing based on how much money you want to make and then what you want your actual work to look like.
Dude, it's funny. So corporate was the same way for me, right? Being in the sales world, the higher you move up, the less selling you do. The more internal corporate you deal with, the more customer issues you deal with, the more you deal with the product, right? Which is a similar thing too. For you, the higher you go up, the less you become involved in the day-to-day of what you got into when you first started. So I think it's a really important thing here to think about is that if you're starting a business, understand that if you grow, things will change. And also be really intentional too, like what you want your life to look like. Some people are, if they can make a few $100,000 a year in an awesome lifestyle business, they may only need to buy one $10 million deal per year, and they're totally set. But if you want to go grow and hire people and scale, you have to do a lot more volume of deals to keep up with that. So it's understanding what you want your life to look like and designing it from the inverse of it. But if you want to be able to go wake up at 10 o'clock and go travel cool places, we're not going to have 150 employees quickly.
And you're probably not going to want to have an office where you need to open a suit and tie every day because your employees who you hired are expecting you to, right? It's like, your business runs you to some extent, depending on how you set it up.
Yeah, so it's important to be super intentional with what you want to look like and always reassess too, is like this direction I want to go. And it's not a right or wrong answer. Like there are people who may view what Rob's doing as this is way too much. People may view it as this is not enough. And it's figuring out where you want to go be and aligning your work and your life and your business to go all row in the same direction. So before we hop off here, Rob, thanks for diving deep into this. I think it's a topic that people don't talk about enough as it relates to where money comes from, where dollars go, right? How to go evaluate deals. So if someone's looking to go and create a lead magnet, this awesome lead magnet is how do sponsors get paid? Where do investor returns come from? So lead magnet idea for someone who wants to dive deep into this. I think you guys may do it as well eventually. But yeah, thanks for coming on, Kevin. Kind of talking on a topic that is not covered enough.
Yeah, thanks for having me. It was definitely a fun conversation.
Yeah, and if you're an operator looking to go learn how to raise more capital, connect with fund managers, connect with other operators doing cool types of deals as well, or if you're a fund manager looking to go learn how to scale your capital business, or if you're a high-end seller, a doctor, a lawyer, and looking to go break into the world of capital raising as a fund manager, definitely check us out at Fully Funded as well. So Rob, thanks for coming on here too today.
Cool.
Thanks for tuning in to the Fully Funded Show. If you enjoyed today's insights, hit follow. Share with your investing pals and drop us a review. Connect with us on social media for bonus content. Your success is our mission. Keep those funds flowing. See you next time.